Asset classes are long term, stocks and sectors are not long term. Remove this myth that this stock is long term. There's nothing like that in life. So let's say with that post event, we were the worst performing mutual fund in that particular month. Okay, that particular quarter we were the last in all the categories, but come January 2024 we are number one again. Obviously some amount of hype got created more on the SME space where liquidity is hardly anything, everybody was chasing. I don't think there is any euphoria in a broader market. Okay, that you give 30% weighted to momentum, 30 to value, or some 20 to quality, whatever you define, and every 6 months, yearly, you can rebalance. These are static style. Globally, this is a failed product. Okay, some people consider as a new term like smart beta. Okay, instead of saying factor based, I'm using the smart beta. This product has failed globally.
Where will value creation happen in the next decade? Think about it. You open your phone, suddenly there's a news piece of a stock rallying, another news piece of a stock falling. Suddenly there's a new piece of tech that has completely changed the game. In that context, as investors, how do we know where to invest? Our key speaker for this session is Mr. Sandeep Tandon, the founder and chief investment officer of Quant Mutual Fund. With over 2 decades of experience in the finance services industry, Mr. Sandeep Tandon will share his perspective on sunrise opportunities in the next 10 years. Moderating this chat is Mr. Neil Borate, Deputy Editor at Mint. Mr. Neil Borate has been writing about personal finance for the past 8 years. He even co-authored the book, The Big Bull of the Lal Street. May I please invite Mr. Sandeep Tandon and Mr. Neil Borate on stage for our next session. Big round of applause.
If we can start with, if you can tell us in 3 lines, what makes Quant work? One thing that all stock pickers do at some level is to compare themselves against a mutual fund. So a lot of FOMO you've created, people don't know how it works, it's just how you do it. And that keeps people on the sidelines. People say that because I don't understand it, I will not invest. The other thing is people say that it's a temporary phenomena. It's 1 year, 2 years of massive returns. This will mean revert. And that keeps people away as well.
Like every investor chase returns. Okay, we very proudly say we are in the business of risk management. Returns are byproduct. The day you start assessing your risk and managing risk proper, things will change. The problem only starts when you chase returns. And this is the one aspect which help us because we are not emotionally attached with anything. Okay, and hence we are able to generate a superior risk-adjusted return on consistent basis over years.
So Sandeep, if I could go into your history a little bit. In 2022, most mutual fund houses were avoiding a particular corporate group. I won't name it, there are restrictions. But you guys ventured and reaped the huge returns from it. And in Jan last year, there was some news about the group and report came out, a lot of panic, at which time you exited. So what was the thought process at that time?
So let's say example with Neil talked about our corporate event happen. So we have 6% exposure to this group. Okay, the impact was not very meaningful. The collateral damage was somewhere else. The collateral damage was PSUs. We have more than 20% or 25% PSU exposure. Okay, so if you really sit back and analyze, 1 year later now, or maybe more than that, we were way ahead in taking a PSU call, way back in 2023 versus 2024, where we are seeing some amount of euphoria getting built. So that's first important. Now let's look at the question which he asked, how you manage the risk. So let's say with that post event, we were the worst performing mutual fund in that particular month. Okay, that particular quarter, we were the last in all the categories. Come March quarter 2023, we were worst performing. Come July 2020, the second quarter, we were the last quartile. But come January 2024, we are number one again. Okay, so what is very important is that how you manage your risk. Okay, if it's a risk-off period, then you have to lie low. That was the risk-off period. When risk-on cycle came in our favor in October, and we said on the call, the risk-on rally on the horizon, we played it very well. We played on front foot. We generated extraordinary alpha what we lost earlier.
Now, Sandeep, we are supposed to talk about value creation over the next 10 years,
Yeah.
but your portfolio changes 10 times in 1 year. Um, so given, no, you call it dynamic, right? You don't have this thesis that, look, I'm going to pick companies that will do amazingly well for the next 10 years. You change your mind all the time. Um, so can you explain that strategy a bit more? Like, how do you take that long-term horizon also into account?
We live in a very dynamic world, so money management style cannot be static, it has to be dynamic, and hence rebalancing comes into picture. A lot of people define as a churn, the point which he talked about. So what is important is that what is your need, how you define your style. When we manage money or from a risk perspective, we take the way portfolio is constructed, we have a decadal call, long-term call, medium-term call, short-term call, hedge call, cash call, even special situation. So it's a combination. See, when you look at from a very simple risk perspective, when everybody say I'm a long-term, yes, investors are long-term, asset classes are long-term, stocks and sectors are not long-term. Remove this myth, this stock is long-term. There's nothing like that in life. Why everybody talks about long-term? Because managing long-term risk is very easy. Your mistakes are hidden for 10 years perspective. If you say you make 3 mistakes, 10 years it's hidden. When you manage your short-term, medium-term and near-term risk, you don't only protect your downside, actually generate alpha out of it. So we take a decadal, multi-decadal call can be identified through Earth analytics. So if I have to talk about very short term or near term, we use money flow analytics. So everything has to be mathematically decoded. We are students of applied maths, applied economics, applied science. We don't have to write a white paper out here. We want to capture every moment. So we define ourselves as an unconstrained fund house. Idea is very simple, that we are opportunists. Anywhere if I look at superior risk-adjusted opportunity, we'll try to capture.
Now, Sandeep, over the last decade, a lot of value creation has come from banks, IT, pharma, etc. Do you anticipate a change in market leadership? There's a lot of talk about China plus one, Make in India, etc. Will manufacturing actually take center stage?
Now, when I'm talking about India, perception has changed. We say that this decade belongs to India, maybe half century belongs to India. That is level of bullishness is there. Something has changed for India. And hence, we all advise a lot of people, don't move out. We think if I have to look at from purely from a perception, we believe that easy phase of banking is over. Because leverage economy as a concept globally is declining. And the relevance and banking is a byproduct of leverage economy as a concept. That's the reason we are relatively more cautious. Okay? And hence we feel that IT boom which we have seen or the banking returns which we have seen, the next decade thesis is all about manufacturing and infra.
So Sandeep, if I can play devil's advocate with that for a minute, we've all benefited from the boom in the Indian stock market over the past couple of years. But is it time for us in this room and throughout the country to have an India plus one strategy? Because how long this can last, how long these kind of returns can last, I'm sure is a doubt that many of us have. You don't as yet have a global fund. Any plans to go there?
So, first of all, obviously, with a lot of restrictions right now, it's restricted. You can't launch any global funds right now because mutual fund as an industry has hit the limit. The point which we are trying to highlight, yes, India is in a very unique situation. To emerge India as an asset class will take some more time. My personal sense is that maybe by end of 2025 or beginning of 2026, that's a time when global market for whatever reason start underperforming or consolidating, then India re-emerges again. If you are looking at purely from valuation aspect, yes, well, markets are slightly stretched, answer is yes. The moment you bring liquidity aspect, what's for liquidity in 2000 versus 2024, we are few hundred times. If I have to look at the second aspect, when you're talking about valuation is the one dimension, second dimension we bring a liquidity. There is no sign of any problem. Third aspect you bring, the third dimension you bring is all about the risk appetite sentiment. What was the sentiment in 2007-8? India barely managed that crisis. 2018 versus even 2024. The perspective is very different. India is in a very different league. So the third dimension is not also giving you any signs. So when we talk about these three dimension aspect into angle, then you realize the problem is only in one dimension, two dimension data. So 2/3 weightage is supporting the bull run, 1/3 is not supporting. And that's the reason we bring the fourth dimension, the timing. So a lot of people think timing is a risk mitigation tool. Timing as an analytics is a function of all three: valuation analytics, risk appetite analytics, and liquidity analytics. When you combine as a whole, you get a very different answer. And that's the reason I'm saying, if you have a big vision, 10 years perspective, few decade perspective, India will emerge as a separate asset class, but it will take some time, maybe a year or two.
All right, Sandeep, let's turn our attention now to mid and small caps. They've had a massive rally in the past year. SEBI itself is concerned about the valuations, and they've asked the mutual fund industry to do stress tests. How soon can MFs liquidate their portfolios if there is an adverse event? Now, one of the justifications given for the mid and small cap rally is that there are many sectors in mid and small cap which are just not there in the benchmark index. They're not there in the Nifty and Sensex. Do you agree with that? And are there other reasons also that has driven this? And will it sustain?
Okay. So obviously, when we see market as a whole, obviously regulator's responsibility is to keep on give you warning sign. Obviously, some amount of hype got created more on the SME space where liquidity is hardly anything, everybody was chasing. I don't think there is any euphoria in a broader market, okay? Now coming back to a very specific thing, if we believe India manufacturing story or India infrastructure story, then I think all mid and small will do very well. Maybe it has done extremely well in last 3-4 years, so maybe next 1 year, 2 years, it can correct, it can consolidate. If you can assess your risk appetite and your investment horizon, then I think you will be a winner in this game. What is very important to understand, it's a decadal opportunity. We are not worried about, if you have that vision, then definitely mid and small will do very well. And particularly small, because the challenge with this mid-cap space as per SEBI definition is between only 100 to 150s, 150 till 250. So only 150 stocks are there. The challenge is more for mid-cap space, unless SEBI changes, which industry bodies are talking about. We are also harping that you should make top 200 stocks are there, and top next 300 should be mid-cap, and beyond 500 should be small cap. So there is extraordinary opportunity in small cap. There are thousands of stocks are there. So if you believe India manufacturing story, infrastructure story, but don't get carried away. Don't get sucked into some hype which get created, because people notice stocks when you get into this breakout sort of zone or something people are talking about, written about. But if you have patience, keep on identifying these winners, but look at from a decadal opportunity. So we remain very constructive, more on the small cap versus mid cap, because the basket itself is very unique.
You've grown from a few hundred crores in 2018 to more than 75,000 crores of...
We're 84,000 now.
84,000 crores of AUM now. Are you too big to get into the small cap zone to continue to generate alpha there?
Okay, this is again very important myth, because what happens, sometime mutual fund houses defined that this is the minimum market cap, okay, we will invest. The way we design our portfolio is that if you have a decadal opportunity, many stocks in our small cap are there for a long period of time, 3 years, 4 years also, okay? So those are decadal opportunity, we will definitely allocate, but we will not allocate extraordinary money towards this, okay? So maybe illiquid stock or decadal opportunity stock can be maximum 20% in my portfolio. That's the way we have designed, okay? But we call ourselves as an unconstrained fund house, okay? So we are not affected by when I say we are market cap agnostic, thesis agnostic, okay, sector agnostic, we will definitely capitalize that opportunity as long as we are clear on that.
Assuming, Sandeep, that there are some companies that are just too small for you, so micro caps, few hundred crores, a lot of stock pickers in the house today, is there an advantage that retail investors have there? Like, if I am a stock picker, I can't compete against you in large, mid, or even small as it's currently defined. But if there's a company with a market cap of few hundred crores that I've spotted, which you can't get into, is that the last edge that the retail investor has, truly?
I will not call it a last edge. Definitely, there is opportunity for you, because many bigger houses will not look into it. So what is very important to understand from your risk perspective, what should be allocation? It should be opportunity, yes. If you have that decadal view, answer is yes. But you should able to do that much research, or you have that much understanding and patience to hold for that horizon. Yes, some edge you have, but don't look this as an edge, and don't try to give extraordinary weightage in a portfolio. Let's say if a decadal opportunity, overall portfolio of small cap of Quant Mutual Fund will not go more than 20%. Similarly, you have to define these number based on your individual risk appetite, and that you can only assess better than anybody else.
There is a notion that the market is driven by factors. So value, for example, or low volatility or momentum. And there is an idea that momentum does well in bull markets. Now the bull market has aged. We don't know if it's ending or not, but it has aged. And if there is a rotation of factors, let's say towards quality, how would you position yourselves? You say you're not momentum, but a lot of people perceive Quant that way. How would you position yourself?
Okay. So let me give you some perspective. First of all, we practice a very dynamic style of money management. All factor-based, smart beta, whatever terminology you can use, these are all static allocations that you give 30% weightage to momentum, 30 to value, or some 20 to quality, whatever you define, and every 6 months, yearly, you can rebalance. These are static style. Globally, this is a failed product, okay? Some people consider as a new term like smart beta, okay? Instead of saying factor-based, I'm using the smart beta. This product has failed globally. Why the 2008 then liquidity crisis emerged? Because all these quant models of factor-based model were working. Everybody was in one direction. When reverse happened, there was a reverse circuit, and globally also this problem happened because everybody was chasing momentum or whatever parameter they will, predominantly momentum. So that product failed in 2008. When you go back in 3-4 years, people analyze what went wrong, and then the evolvement of quantamental style of investing came. Okay, where you combine the sentiments data along with the valuation or the fundamental of the companies. That's the way quantamental got evolved. And we believe we are practitioner of quantamental style of money management, where blend all these data points together, it gives you better. So I'm a not great believer of factor-based model. A lot of people in their own quant fund follow these theses. I think it's a outdated technique, and it has lost its relevance globally.
So the final question to you, Sandeep, from my end. It seems that Quant AMC is essentially you. Like nobody else knows fund managers other than you. You are the brain behind it all. You are how the magic happens. If something were to not happen to you, but if you were to retire, go on holiday, whatever, you were not to be available, would we get the same performance?
This institution get built over a period of time. Somebody has to take the initiative. So within Quant, I'm a director in that sense. It's my initiative. But we have a process, we have a team. So we practice multi-asset, multi-manager. Within Quant, we create specialists. Rather than saying that I do everything, there is a specialist who do something, okay? And we try to combine. That's the reason in Quant, the importance of one money manager is not there. It's a team which deliver. The team which was there was managing 27 crores. Same team managed 84,000 today. So it's all about processes we have built is very, very scalable. It's not about one. Thank you very much.
Thank you so much.
I think this conversation really gave us some insight into the Quant Mutual Fund way of doing things, approaching investments. And while decadal opportunities are the way to go, as retail investors, one should be armed with research and a lot of patience. So thank you once again.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and or other instruments traded on the stock exchanges.